All right, so my name is Fan Yang, CMT and Chief Technical Strategist here at fxtimes.com. And in the next hour or so, or 45 minutes or so, I'm going to share my technical assessments of some of the majors and also talk about some trade plans that could go with those technical setups. And then I'll open up the room for any questions. But, throughout the webinar, if you have any questions, feel free to throw that on the chat and I'll try to answer them in a timely fashion. Okay, so first, I guess we could look at the euro dollar. Seems like everyone is looking at the euro these days and pushing it up. We had a triangle last week. The market broke above that triangle and it was quite a sharp rally. Couldn't quite reach 1.35 today, and the market retreated to slightly below 1.34, but at the moment is still respecting this rising trend line. Okay, so in the short term, we're getting a pullback or a throwback from a pretty sharp bullish attempt. Okay, now let's take a look at the daily chart. I believe the euro dollar is going to be at some important resistance levels. So if you take the Fibonacci retracement of this latest swing, downswing, and you see that 61.8% retracement, declining trend line here, which is a projected channel resistance, and this 200 moving average, all are going to be around 1.36, a little bit above 1.36. Okay, so if the market can push above 1.35, your 1.36 up to 1.3650 area, that's going to be an important resistance area. And for me, I'm going to be looking for a short there. Just remember, trading Forex involves a substantial risk of loss and may not be suitable for all investors. This webinar is meant for educational purposes only, not trading recommendations, but I'm going to share with you what I would be looking for and the risk, the reward to risk for these trade setups. Okay, so this is I'm waiting for the market to come up here, come to me towards 1.36 area. Okay, and the target from there, I would say try to be conservative and reach for 1.30, 1.33 and 1.3320 area. Okay. Okay, good question, Ganster. Before I continue, I should really explain the technical tools that I use. Okay, I'll just go from bottom up here. RSI, 14-period RSI. I have 60 and 40 additional lines added in there. On the chart here, you could see, trend lines and pattern, support resistance levels. I use the Fibonacci tool to look at retracement targets. And you'll see all these moving averages. So they start with the 200 moving average, which is what the Bollinger Band is actually based on. So the Bollinger Band conventionally is, I think, 20 using the 20 moving average and 2 standard deviations. I use the 3 standard deviation and 200 moving average. I want to create a wide band so that when the market does tag it, it's usually very overextended. If you have those Bollinger Bands at 20, you get a lot more false signals of the market being overextended. Okay. You'll see me using the 100, 55, 21, and 8 moving averages here. What I use them for is to help me visualize when the market is in congestion. When the market is in congestion and there's a breakout, that's usually a good sign of direction. For example, back here, 2011, July and August, you had all these moving averages move together and then break to the downside, and then you see the moving averages spread out, and that's a good sign of a trend development. Okay. All right. So those are some of the tools I use, and feel free to ask any other questions about those technical tools. Now let's take a look at this trade plan. Okay, from the medium-term perspective, once the market gets toward 1.36. Okay, so from there, first of all, I want to look at the risk really this market can go all the way up to this higher trend line, right? That would be near 1.39, 1.3950 area. Okay, so if the market breaks above this trend line, even though I'm still looking at the euro dollar as a, with possible shorting trading plan, I would exit and reassess it once the market gets to 1.39 area. Okay, so that means the stop, we should probably put the stop slightly above 1.3650. Okay, so let's say our stop is at 1.3675. Okay, and we start planning the trade at 1.36. That's a 75 pip risk for about a 300 pip reward. Okay, and you could scale up. Once you're at 1.36 and you get some initial bearish signals, say you get in, but the market keeps going up, you could scale in at 1.3640, for example, and then you get an average entry price of 1.3620. That actually gives you a better reward to risk than your initial entry if you were to enter at 1.36 or slightly below that. Okay, so here I would plan on 2 entries to around 1.36 with a I might even put the stop actually above 1.37, because 1.37, once we get there, is this 200-day moving average, and I want to give it some elbow space above 1.37, so you could see, possibly almost a 100 pip risk for about a 300 pip reward from that point. Okay, so that is the euro dollar medium term trading plan. Looking for that. Another thing we should monitor is, this is the technical assessment, but we know that there are a couple of important risk events this week and next week that could provide for one of those buy the news, sell the rumor scenarios, right? LTRO2 on, I think, Wednesday, the 29th. Then you have the ESM discussion on the European stabilization mechanism. And that goes through Thursday and Friday and probably won't conclude till next week. So these risk events right now, it seems like the market is pricing in hope, right, for these risk events. But once this week is over, that could dry up very quickly. And that's the scenario I'm looking for. And if I'm wrong, the market pushes above 1.37, then hey, we go to the next target here, 1.39, 1.3950. Okay, then reassess. Alright? So this trade for me would probably begin later this week, or even the beginning of next week. But we do get non-farm payroll also on Friday, so that's going to be another important risk event next Friday. Okay? Alright, so that is some pre-planning for this euro dollar trade, shorting from around the 1.36 up to 1.3650. Okay. Alright, what else can we look at? I like the dollar yen. I want to buy on a dip here. Today we're getting a pretty strong throwback. This is what I call a piercing pattern. We started, so relative to this previous bull candle, we started the next daily candle higher than the close. And then it dips down, crosses the middle of this previous bull candle. And if it closes below 80.50 today, I believe this is a good sign of at least some short-term pullback, some short-term retracement to this almost unimpeded rally from 76. Okay. Ganster, are you talking about the dollar yen or the euro dollar? ABC. Okay, so yeah, this could be one of those ABC corrections, right? And then followed by a bearish attempt. To me, though, that is a possibility, but my preferred scenario is that we are in fact bottoming. Okay, we're getting. Let's see. Let's just look at this daily chart. Actually, maybe even a weekly chart. Okay. In the weekly chart, you could argue that we broke quite important resistance coming down, right? Another important clue in the weekly chart that warns against the shorting scenario is that this RSI has shown a loss of bearish momentum. Why do I say that? The reason I add the 40 and 60 level on the RSI is that when the trend is bearish, the momentum represented by the RSI shouldn't push back above 60. So you have this several times. The market had some pretty strong rallies here. Okay, these pretty strong rally attempts, but they all have been, as far as the RSI, they were all contained below 60. I got you again. Okay, so this means 60 is an important level. Now we broke above 60 now in the weekly chart, and if it kisses 70, that's going to be a very major clue of a significant retracement of this like 5-year dip. Okay. And if you look at these rallies that I would, the current rally, I would use the analogies of this one over here, this one over here, this one over here. And these lasted several months, 3 months. This one lasted, let me see, this one lasted from March to, okay, this was a 5-month rally. This one was a 3-month rally. This one was a 6-month rally. Okay. So, no cursor showing. Okay, so I'm just showing these major rallies and anticipating the length of the current one. Okay, this could be several months. Okay, I would say 3 months. This one here was 3 months. This 5 months, 6 months. So if this is a major rally, it could take a while, and therefore in the short term, we could actually be catching the beginning of this trend when you go back down to the daily chart and look at the current dip. Okay, so for me, I'm going to start planning the rally here around 79.50 all the way down to 78.25. This is my buy zone. Now, why is the yen losing so quickly, so sharply? Well, from here, I would say there was some fear of intervention when it's near 76. Okay, but really this took off when the Bank of Japan expanded their asset purchase program, which pretty much means expanding quantitative easing, expanding liquidity, and by expanding pretty much supply of that currency, and that would be pressure on the currency, right? So that's a major theme, a major fundamental factor for the yen, that that the Bank of Japan is running more asset purchase program. Okay, that's the type of fundamental event that could last several months. We're already in the first month of it. Okay, so yes, so this is. Now I'll be looking for some kind of dip here, and like Ganster says, I like ABC patterns going down. Okay, now regardless of the pattern going down, I want to take a look at the risk to reward here. If your first entry is near 79.50, okay, now the first target would be just back up to the 81.50, 81.70 area, which is let's say 81.60. So that would be the first target. Okay, and looking at this, a stop for me would have to be placed below 78. Okay, and that's where this 200 moving average is. Okay, because look, if it breaks above the 200 daily moving average, comes down, and stays on top of the above the 200 daily moving average, then it's going to be giving us very clear signs of the bullish intent. So if it breaks below that, then I say the trade plan was wrong, and the market continues to be in sideways action. But this current swing could definitely be followed through with another one. So what is the risk there? Well, if you plan the position at 79.50 with a stop at 77, like 65 or something like that, that's like 85 pips. Oh, I'm sorry, that's more than 85. Let me see, 150. That's like 185 pips of risk. That's too much, right? Especially if your potential target could just be the previous high here, right? That's pretty much a 1-to-1 reward to risk, right? So from here to here, from here to here, it's pretty much a 1-to-1 reward to risk. Now, there is a way if you plan on a second entry here, if the market dips down toward say 78.25, let's say we get in at 78.30. So 78.30 and 79.50. No, that's what's the average of that? That's about 78.90. Okay, so if you plan for a second entry, then your reward to risk profile will look different because, right? First entry, second entry, then your average entry would be 78.90 around here. Okay, now from there, 78.90, your risk would be about 130 pips. Okay, 78.90 down to 77.60, for example. That's 130 pips. Right? While your reward side actually increases a bit. But now it's more than 200 pips. It's about, let's see, 60. So that's okay. 78.90 to 81.57. That's what 270 pips. I don't want to be wrong there on 200. Yeah, around 270 pips. So you improve to a better than 2-to-1 reward to risk. Okay, and really that's a conservative target for this bullish market. Okay, I would say a more aggressive target would be, let's go back to the weekly again, would be this pivot here, pivot zone between 84.50 and 85.20. Okay, that represents your 2011 high and your 2009 low. That's that pivot here. Okay, and if that is the more aggressive target, okay, let's say 85 is your target. That gives you what? That's about, let's see, 78.90. That's about 600 pip potential reward to 130 risk. So a little better than 4-to-1. All right. So this trade setup has a 2-to-1 and an aggressive 4-to-1 reward to risk. If you plan to scale in 2 entries one at 79.50 and the second one at 78.30 if it gets down there. Okay. Or Ganster 6-1. Okay, so rushing it with the math a little bit here, but I hope I'm not trying to get you the exact numbers. You could even just visualize the risk to reward. Okay. All right, so that's the dollar yen. Okay. And I think we wanted to take a look at the pound dollar. All right. Pound dollar, looking at the daily chart, there is let's see. It's to me right now, it's this looks like it's ranging, right? There's still a bearish tilt. Market trading under the 200 moving average. There's some bearish tilt, but pound dollar in the short term has a bullish bias. And I think if it breaks out of this range, breaks above 1.5930 40 area, we go to our next pivot at 161, just above 161. All right. Now, where would I try to enter for that trade? I would actually wait till we get towards the bottom of this range. Okay. So in this market, I'm looking at this market as a range-bound market. Okay, with possible bullish move towards 1.61, but to get a better reward to risk, I would need to trade it near 1.57, 1.5650. Okay, because if we drop below that, let's say we drop below 1.56, okay, I would be looking for the market to retest these lows and invalidate that bullish plan. Okay, so let's say this is the target, the risk being the market falling below 1.56, let's say 1.5580 area, or 70 area. Okay, and your targets could be here, and then more aggressive target to be here. Okay. Yeah. So right now within this range, and as the market is at the higher end of this range, there's no trade plan. But if this market comes down near 1.5650, I think there could be a bullish plan from there. Okay. And another clue in this daily chart, if the RSI gets close to 40, in a consolidation mode, we could get support. Momentum in a sideways market could be supported at 40, especially in consolidation. All right, so looking for 1.5650. Okay. All right. Let's see what other pairs are interesting at the moment. There's another trade plan I have for Euro Swizzy. Okay. Euro Swizzy is a special pair. Okay. So we all know, or we should know, about the 1.20 price floor for the Euro Swizzy. That is the SNB's pledge to support the pair above 1.20. This was pledged by the previous SNB chairman, Hillebrand, who retired or resigned, and now we have Mr. Jordan at the SNB. There are some Swiss economic data, and I think the worse the data gets, the more political pressure. Well, central bank shouldn't be involved in politics, but there is still that pressure to support or to for the central bank to go against Swiss strength. Okay, right? You want to lower your currency so that exports look more attractive and therefore more competitive for the goods from your country. So the lower the Swizzy, or the stronger the Swizzy, the harder it is to get exports out, harder to get the economy going. And that is the reason we are looking at 1.20 as a very important support. Okay, last time we touched 1.2025 before a rally towards 1.2125 30 area, and now we're back towards those levels. So let's create a trade plan revolving the 1.20 floor. Okay, let's go to maybe a 4-hour chart here. Okay, so first of all, we're getting this ABC correction targeted to like 1.2033. Okay, I want to take a look at a trade plan that starts at 1.2040. Okay, which is where we are right now. All right, so let's say let me just look at the daily chart. Okay, so 1.2040, if that's our first entry, what is the risk there? Well, we have to give 120 some elbow space below that. So let's say 1.19, 60 or 65, that could be your stop. Okay, so from 1.2040 down to 1.2060, let's say, that's 80 pips. Okay, that's 80 pips, and your reward, well, first target is our previous high here, which is at 1.21. Let's round it down to 1.2120. Okay, so that means 80 pips reward. Again, this becomes a 1-to-1, right? 80 pips risk from 1.2040 down to 1.1960. That's 80 pips, but 1.2040 up to 1.2120 is also 80 pips, and that's a 1-to-1. So not a very attractive outlook, and there is still possibility of the market falling lower from 1.2040. But if we plan for that, let's say we plan for another entry just above 1.20, let's say 1.2010. Okay, so the average between 1.2010 and 1.2040 is 1.2025. And in that scenario, you get about 65 pip risk to about 105 pip reward. Right? Still a little low. It's still lower than 2-to-1, but slightly better. Now, keep in mind that is that's a conservative target here. The second target is 1.2240, and with that target, you get a lot better reward to risk. So, the way I look at it is, you look at your first target and you assess your reward to risk. If it's 2-to-1, I like it. If that first conservative target is 2-to-1, I like it. If it's less than that, it's not as attractive, but it's not completely a deal breaker, especially with this 1.20 floor there. Okay, so in this, if it goes up to 1.2240, that is about a 215 pip risk to your 65 pip. Reward to your 65 pip risk. So that's a little better than 3-to-1, almost 4-to-1 or 3.5-to-1. Alright, so that's your trade plan. If you start at 1.2040 and plan for another entry at 1.2010 with the target of 1.2240, you get a little better than 3-to-1 reward to risk if your stop is at 1.1960. Alright, so that's the Euro Swizzy intervention watch now below as the market trades below closer and closer to 1.20. Okay. All right. Let's see what there are some other interesting pairs. Maybe I'll just do some assessment. Guys, let me know what pairs you guys are looking at, what you guys are planning to trade. Take a look at those. I want to do a quick look at the Kiwi. Definitely a sideways market, congestion. Now, market is back at this range high. So break of 0.8420 opens up the bullish outlook. And the daily chart, hang on. Weekly chart, okay. So for the next pivot, now we could be looking at this 0.8560 area when the market's above 0.8420. Okay, so bullish market. There's definitely the bullish bias, and look out for that break. Wonder why I can't resize this. Hang on. Sort of stuck here. Okay, you know what? Forget the Kiwi then. For some reason this chart is not rescaling. Let's take a look at many of your stop placements and targets are quarter points, which I look for. Len, can you explain what you mean by quarter points? Not a term I'm very familiar with. But I guess, instead of at the 50 and whole numbers, they're sort of in the middle of those. That's where stops. I try to put it under a whole number or 0.50. Yeah, okay. I see. That's what you mean. Yeah. I tend to respect whole numbers and 50 a lot more. Okay. Aussie dollar, another interesting pair. Because it is bullish. It is in some kind of flag. Okay. And if you look at this market, since the all-time high here, it looks like a ABC, and then another ABC back up, and then we might get another ABC down. So, yeah. But for now, it does look bullish, and it could even be that we have completed this ABC, right? And this could be 1, 2. This could be a nested 3 going up. Okay, so I do have a bullish bias in the Aussie dollar from the technical perspective, but in the short term, towards 1.1, 1.1080, these record highs. Okay. Now, as far as trade planning, I wanted to see it come down towards this area, 1.04, and then I wanted to aim at 1.0750. So 1.04, aim at 1.0750 with the possibility of a second target toward 1.10. Okay, so I'm waiting for that. The market hasn't come to me. Instead, it might actually never reach that and just continue higher. Right, this sort of flag pattern development. And then we would be looking at a break towards these highs here. Okay, so not much to do for me here in the Aussie dollar. Sometimes you just have to wait it out. I don't want to take a risk right now. Trying to go long with possibility of a lot more retracement. Okay. All right. So yeah. So if this retracement does extend lower, look for it around 1.04. Okay. So that's the Aussie dollar with a bullish outlook. Okay. So Kiwi. Kiwi Loonie. Well, okay, I don't usually look at the Kiwi Loonie. I usually look at the majors, but let's see. You know what? Before I address the Kiwi Loonie, let me just address gold. Out here, I've been talking about this break, and you see here all these moving averages are congesting, and we have a wedge. Okay, and here the market initially you had some breaks to the downside of these moving averages, but an important clue in this 4-hour chart is the RSI pretty much maintained above 40. You see here, since the RSI tagged above 70, it has come down and supported at 40, supported at 40, and then when it was stuck between 60 and 40, this is sort of where the Aussie dollar is right now, a bullish market with the momentum stuck in consolidation. But in gold, it seems like this could be like a one step ahead of the Aussie here. It broke to the upside here. Okay. So the momentum breakout was to the upside. Price breakout was to the upside. All right, and now you see the moving average is expanding. Good sign of a bullish continuation. And when you look at the daily chart, your next pivot is up here, 1800 up to 1802.03 area. Okay. From there, we could look for some very short-term resistance, but look, this market, since the record high here, is pretty much a range-bound market. Okay, and we're in a bull run within this range-bound market. So only, in the short term, I would say I see this going to 1800 and possibly even back to test these highs. But to me, there's not much of a trade there to go, to push up there. The trade for me is if this comes back down here. Okay. And bounces off this 200 moving average. Then I would look for it. If the RSI comes down, can't break 40, or as the RSI is nearing 40, I would start to put on another bull position. But at the moment, if you're, if you have a long position, I would say you could probably hold onto it to 1800, where you might want to scale out or even just get out of the market around 1800. Okay. Yeah. So this trade, since the breakout, it's too late now. It broke out early last week, and maybe you get a pullback. It's just that we're so close to 1800 now. I don't think the reward to risk is worth it going up. Yeah, so let's go. The analysis is that it's still bullish up to 1800, but listen, not all analysis and the scenarios are tradable in my book. So to me, I'm not going long in gold anymore. This was a good place to go long here with a breakout, but there's too much risk now, I think. Okay, Malik, I'm sorry, I should have read your question before I moved on. 1800, yeah, there could be a plan from 1800 to short down to 1750, give it like a $10-15 risk. So that would be, $50 reward for $10-15 risk. I'm not confident on that, but the reward to risk could be there to short around 1800. Okay, so let's see. Bullish head and shoulder in gold. I don't really see that. Sam Shale. I don't really see that bullish head and shoulder. Not sure what you're talking about there. I guess, is it in the daily chart? 4-hour chart? In any case, we'll want to take a look at Kiwi Loonie. Josh, I gotta say that's not a pair I usually look at, so I'm gonna. Alright, so here's the daily chart, and we are attacking these 2011 highs. The market seems to have flattened out a bit. It's coming down here. I would say there could be a trade plan here to look for sort of a reversion back to the mean. Like, for some reason, this data doesn't go all the way back here in this platform. Again, Kiwi Loonie, not a pair I usually look at, but we could still talk about some kind of trade plan from here. Okay, so this is I would say this is a range. I set up this range because look, RSI came down to 30, and that shows that it's flattened out. If it stays above 40, the momentum's still bullish, but once it tags 30, it means the market has flattened out, and I would look for a reversion to the mean. Reversion to the mean means we're looking for the market to return towards the middle of the range. Okay, so 0.81 area, I would say that could be a target. 0.81 from 0.84. From 0.84. Okay, so 300 pips. Now, let's say you put it up to 0.8435, 40-ish, 40, 50 pips risk for 300 pip reward. Actually, to be conservative, look at 0.8180, and that would be, that would be 220 pips reward. So the conservative reward to risk, 220 pip reward, that's about 4 to 1. So I guess the reward to risk is there, but we're looking at a daily chart right now, and the market looks like it's bullish. The momentum is bullish. So that's really going against the trend, and we're going to need some confirmations from the lower time frames. Okay, here's a 4-hour time frame that shows not a confirmation right now, but actually a bullish breakout. Okay, let's go to the 1-hour chart. Just want to go down and see what this looks like. Okay, so this is, in the 1-hour chart, what I want to see to set up this trade is the market sort of tag the upper Bollinger Band. I want to see some kind of a bearish divergence with the RSI. And if that does occur around 84, I would get ready for that. Just sort of short it from there. Okay? Just remember, trading Forex involves a substantial risk of loss and may not be suitable for all investors. Just assessing the risk and reward and potential trade plan. I'm not giving you that trade recommendation per se. Alright. Okay, fundamentally I'm looking for an upside break, and you know what? If it does break above what was it, 0.94, it'll be a very quick clue that we'll be wrong, because 2011 high, that's a pretty important high there, and if that breaks, we'll be wrong for the bearish outlook. But look, for me, it's always good to set up a trade near where you could find out that you're wrong very soon, right? Because the sooner, the closer you are to where you're wrong, that means the smaller the risk is. Okay. Now, the analysis and all that, it's good. You want to find a high probability trade. You want to have the edge from the fundamental bias point of view. At the end of the day, all that's good. It could give you an edge, but the most important thing is setting up that reward to risk assessment, and the decision process has to be based on that, not just how likely a scenario will turn out, because as a trader, you're not trying to predict there is an element of prediction and forecast, but to act on it, you have to hedge that with your ability to control your risk. So that's the more important thing to do. Okay, so I need to set up long above 2011 highs. I wish I had more data for that pair. Let's go to the weekly again. Oh, okay. You know what? It seems like the platform filled out the data finally. Right? And when you look back at this is actually a pretty important pivot going all the way 84.74. Okay, so there's some important clues. We might have to set the stop above 85 and plan to scale in, right? So right now it doesn't look like 84 is going to hold. So if it does break above 84, let's say you enter 84.20 and then enter again near 84.70, then you could get an average near 84.50. Okay, so there is still some room to the upside within the bearish outlook. Okay, but if that breaks, if 85 breaks, now we're looking at these pivots up here. Okay, 87.80 area. Okay, before attacking the 92.30 area. Okay, interesting pair. Instead of going for this bearish outlook, but you could wait for the market to come down and look for another rally. Go with the trend. Okay, that could take some weeks. It takes several weeks to get back towards these levels. So meanwhile, you could play the counter trend, but understand that this top could take a while to develop as well. But I definitely see this price action in the weekly chart. It has slowed down a bit, although this week is starting strong. So short medium term, look for a topping, but in a medium and longer term, bullish continuation is still in the scope here. And let's take a quick look at the Euro Aussie. Okay, guys, okay, here we go. Here we're having a reaction from the overbought condition here, tagging up the Bollinger Band, RSI in the 4-hour chart way above 70. It's resolving that. Let's see what it looks like in the daily chart. In the daily chart, I mentioned last week, or maybe even 2 weeks ago at FX Times, we're looking at a development of a double bottom. Okay, so we did establish double bottom, and now we're getting a throwback. This is quite a strong candle. It's becoming an engulfing candle, or at least an outside bar, if not an engulfing candle. The difference, outside bar, you're looking at the high and low. Engulfing candle, you're looking at the open close. So even though this open isn't above the previous close, the high today is above the previous candle high. So this is an outside bar in the making. And I would say next couple of days we might be getting some further correction. Okay. But just like Kathy has set up before, I think it needs to break below 1.24 to open up this bearish outlook. But to me, if it stays above the middle of this range, there's still a chance for the bullish outlook. Okay. And yes, I've seen bottoms like this, maybe not exactly like this, but you have some people call it the Cuppinado, where you have a rounded bottom, you have a breakout, comes back down towards the middle, and then shoots up. Okay. So I would actually look for 1.23 area, 2280 area to break before looking for further downside. Okay. Looking at this daily chart, I like the bullish outlook here if the market gets towards 1.23. Yeah. I think there's still some correction that we could look for to the upside. Okay. But I guess my maximum target will be 1.29, 29.25. Okay. In the daily, we're tagging the lower Bollinger Band, oversold. RSI gave us a bullish divergence, but it's resolved now. The RSI has already, it's cracking 60 now. And look, if it does, okay, so if it comes back down, the RSI, and it fails to break back below 40, then goes back up like this, that's a sign that we have entered consolidation and the market is not in bearish continuation. So below 1.24 and with the RSI attacking 40, we still could get support, and that's why I want to be as close to where I'm wrong for the bullish outlook. 1.23 area for a target, first of all, back up to these highs, 1.26. That's 300 pips. Okay. To the downside, break below 1.2250. Let's say 1.22. By this point, this is a tricky one because look, you have these bottoms here, and even if it's not a bull run, we could get consolidation, and that means we could still get support here. But I think it's better to exit earlier than to keep trying to pick this bottom. Okay, so I think under 1.2280, even at 1.2260, we should be out of there. Okay, so about 40 pips risk from 1.23. Okay. All right, so that's the Euro Aussie, looking for maybe a couple more days of decline towards 1.23. If it does that, my trade plan there is a long with initial target 1.26 and initial exit a stop placement around 1.2260. We're going to follow up. It's towards the end of today's session, so I'm going to wrap it up now, and we go over these markets at 8 a.m. in the morning at FX time. So if you're not at any FX Street webinars, do check us out, fxtimes.com. And we'll follow up with these pairs and look at trade plans going forward. Okay. And that would be it for today. All right. Thank you guys. Thank you, Boyke, Bill, Malik, Sam, Josh, Ganster, Len. Thanks for the questions. I thought I did put it in. Okay. So that's my website. We're gonna follow up with morning webinars there, following up with these trade plans. All right. So thank you, FX Street, Vicky, Adinda. Thanks for setting this up. Be glad to do it again next month. We'll set up that schedule very soon. Okay, so with that, I'm going to stop sharing the screen and wish all of you safe and good trading for the rest of the week. Remember, always look at risk first. That's foremost. It's more important than the probabilistic edge you have in the trade. Okay, but of course, you do want to have that edge. Okay, see you next time, guys.